There's a really good chance that you've already seen the bottom in the housing market, and home prices are likely to appreciate further from here. But it's largely dependent on what happens with inflation, what happens with interest rates, in addition to the job market, as well as supply and demand. So in today's video, we're going to give you a second half of 2023 forecast. We're going to tell you what's currently happening in the housing market right now and what you're likely to expect as we get closer through the end of the year to help you become a better buyer, a better seller, and more educated about the current housing market. Now, all markets always come back to supply and demand, where a lack of supply of something drives up home prices. And that's exactly what we've seen in the housing market over the last couple of years. Actually, last year, we saw the lowest level of inventory that we had ever seen on record, sitting at somewhere around 240,000 homes nationwide. And because of that lack of supply and that insatiable demand out there to own a home, we saw home prices continue to rise. That was all until we saw interest rates start to go up. Once interest rates rose from the lows that we saw in January of 2022, sitting around 3.29%, up to nearly 5% in July of that year, we saw more and more homes start to come on the market. It was primarily sellers that felt like they had missed the opportunity to get top price for the home, started putting their homes on the market. And because of that, we started to see inventory build. Now, this was coming at a time when we started to see demand decline due to higher interest rates, which really continued until we saw that high at 7.37% on a 30-year fixed in October of 2022. And this is when all the doomsdayers, all the crashers were out there talking about, well, you heard it here first, the housing market is crashing. And shortly after that, what we saw was exactly the opposite. We actually saw inventories level out a little bit. We started to see interest rates come down, where we started the year of 2023 just under 6.5%. And that was about the same time that we saw inventory peak for this year, somewhere around 472,000 homes. But as interest rates declined to somewhere around 6%, what we saw is buyer demand come out of the woodwork, because there were a lot of buyers sitting on the sidelines waiting for that pullback in interest rates. At the same time, we had seasonality playing into the market. It was the spring selling season or the spring buying season, which is typically the time of the year when we see the most activity. And that's exactly what we saw this year. While buyer demand was picking up, what we saw was less and less inventory coming to the market, because interest rates had locked people into their homes. And because of that, less homeowners were willing to put their homes on the market, trade their current low interest rate for a higher interest rate, likely pay a higher price for a home, in addition to higher property taxes. So instead, these sellers decided to sacrifice, stay put, and keep their homes off the market. And because of that, we've seen inventory continue to decline. At the time I'm shooting this video, there's only 464,889 homes on the market, which is below the peak of 472 where we started the year, and nearly 1,000 homes shy of where we sat last week. And generally, this is a time when we see more and more inventory building, because many sellers out there know that if they don't take advantage of the market now, there's a really good chance that they'll have missed the best time of the year to sell their home. Now, one reason we're not seeing inventory grow is because we're not seeing new active listings actually come to the market. So you're probably watching this going, okay, how is inventory growing if new listings aren't coming to the market? Just because there's less transactions going under contract. So inventory is building with fewer new listings coming to the market. But I like this chart here by calculated risk that shows how many markets out there are being affected by the lack of new listings. And because of the lack of new listings, inventory is not growing, which is creating more competition between buyers and sellers. Now, while we've seen that inventory decline, we've actually seen demand also decline as interest rates have risen back above 7%. But here's the thing, all you need is supply and demand in lockstep in order to create balance in the market. And that's exactly what we've seen. So while there's less demand out there, there's also less available inventory to choose from, which is creating price stability in the market. And we're going to talk about that more when we talk about home prices and the future of home prices at the end of the video. Now, something I always like to point out that's super important to remember is that all real estate is local. So in some markets, you might see more active inventory coming to the market year over year, whereas other markets out there, you have way less inventory on the market now than you did the same time in 2022. In fact, if you take a look at this chart here from calculated risk, it shows that some markets are seeing more active inventory month over month, but year over year, inventory is down. So just make sure whatever market you're in, you're paying attention to the right data and not reading the media headlines. Now, before we dive into interest rates, I would like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. Also, feel free to subscribe to the channel to stay updated on everything real estate related. Now, what happens with interest rates largely dictates what happens with the housing market as well as home prices. Now, I'll be honest with you, I've been wrong about interest rates. In fact, about a year and a half ago, I said that I didn't think interest rates would get above 4%. And then not only did they get above 4%, they got above 5%, and then they got above 6%, and they peaked just over 7% in October of 2022. So I have no problems admitting that I was wrong. I was wrong about interest rates, but I was right on when it comes to house prices, as well as the housing market. Not only has it done well, it's done exceptionally well for those people that bought back in 2020, 2021, and 2022 when I said that there absolutely wouldn't be a crash. But here's the thing, why was I saying that interest rates couldn't go above 4%? So yes, I was wrong about interest rates. I didn't think the Fed could get nearly as aggressive as they did. I didn't think rates could go this high. And one reason for that is because we're nearly $33 trillion in debt. And the higher interest rates go, the higher the payments that the government has to pay on their own debt service. And if any of you out there have been paying attention to the economy, while the economy is still showing some resilience in the job market, the Fed is essentially stuck between a rock and a hard place because they're trying to bring inflation down. But by doing that, they're putting themselves in a more difficult position in having to pay their own obligations in the future. So with that said, I believe the Fed is going to go too far. In fact, I believe they've already gone too far. And at the moment, they're still out there talking about 2 additional hikes. So by the time they do 2 additional hikes, by that time, we'll likely already start to see a slowdown in the economy, even though at that time, we will not have seen the result of those additional rate hikes. So by the time we see those additional rate hikes actually play into the market, because it's a lagging metric out there, it doesn't happen immediately. But when it does happen, the economy will likely have already stalled at that point, which means that you're likely to see the Fed do some quantitative easing. But historically speaking, interest rates tend to follow inflation, which means as inflation comes down, we usually see interest rates come down as well. As you can see from this chart here, which overlays inflation on the 10-year, as inflation has come down, we've actually seen the 10-year go up. And that's primarily because there's a lot of volatility out there in the market. And it's largely due to the fact that inflation is still above the Fed's 2% target, along with employment remaining relatively stable. But at the moment, there are 2 different metrics that are actually keeping inflation artificially high. One is used car sales, which we actually just saw drop as used car sales just tumbled the largest amount since the pandemic. And the other metric out there is the rent shelter inflation data. And what we know is that has about a 12-month lag on it, which is likely to start showing up in the inflation numbers really soon. So as the rent shelter inflation data starts to come down, along with used car sales coming down, we're likely to see larger than expected drops in inflation, getting us closer to the Fed's 2% target. Now, a moment ago, I mentioned the job market. The job market is one reason that the Fed is keeping their foot on the gas pedal while staying super aggressive with their stance on monetary policy. And while the employment market is relatively stable, it is starting to show some signs of weakening. And another thing to note here is that a large percentage of the jobs currently being added in the market are sitting in leisure and hospitality, which are typically jobs at the lower end of the pay scale. So in theory, there are jobs being added, but they're not necessarily jobs that affect inflation like it would be if the job market was growing in higher paying jobs. So in theory, the Fed should be looking at this saying, hey, we are seeing job growth in this sector, but these jobs won't necessarily lead to additional inflation. Therefore, we can take a step back. Now, if you're an Airbnb owner or an investor out there and you're looking for a way to manage your property, I want to take a minute here and talk about DoorLoop. DoorLoop is the sponsor of today's video. DoorLoop is a property management software that provides solutions for landlords, property managers, as well as real estate investors. Their goal is to simplify and streamline property management by providing an all-in-one platform that allows users to manage their properties, their tenants, leases, maintenance requests, as well as the finances for a single location. Now, as a real estate agent and a property manager, I will tell you firsthand, having an all-in-one software to be able to manage your different assets is absolutely key. And some of the things I like about it personally is that it's easy to use. It has a really nice user interface, which is super clean and simple, on top of really easy navigation, being able to get from one property to the next versus some systems that I've used in the past, which are really cumbersome. They're hard to navigate, which is one of the main reasons that DoorLoop stands out to me. On top of that, it has a Zapier connection, which makes it super easy to integrate with thousands of other applications, on top of having world-class support to be able to guide you through the entire process. You don't have to worry about data migration. There's actually a team to take care of that for you. In addition, they have a live chat. They have a 24-hour response time guaranteed during the week. And lastly, my favorite, a real team of people that you can actually call in and talk to if you're having issues within the system. One of the systems that I've used in the past, everything was done via email. It was very hard to be able to figure out when you had a problem. That's not the case with DoorLoop. They make it really, really simple by having that world-class support team to be there and hold your hand. Now, some of the other features of DoorLoop that I did want to mention here is that they have automatic rent payments where you can accept your rent payments online, in addition to automatic listings, as well as maintenance management, a full accounting suite, a custom website, leasing and screening tools, and also a mobile app so that you can navigate on the go. If you're interested in learning more about DoorLoop and how it can help you manage your properties, there is a link listed in the description below. So now that we've talked a little bit about where we've been over the last year and a half, let's talk about the future of the housing market. For one, I think inventory is likely to peak here in the next 6 to 8 weeks. So you're likely to see the peak in inventory for most markets out there by the end of August. At the same time, I think you're likely to see demand pull back as well. So as inventory pulls back, you're going to see demand pull back, which is going to keep those two in balance. Now, where I do see some changes happening is in the inflation front. I believe that inflation is likely to start reporting lower here over the next couple of months, along with further weakening in the job market, which leads me to believe that the Fed is likely to be less bullish towards the end of the third quarter. And at the same time, I believe interest rates are likely to pull back some as well. Now, do I believe that interest rates are going back to the 3 to 4% range right now? I do not. In fact, I think interest rates are probably going to be sitting somewhere in the high 5s, low 6s towards the end of the year. Now, because I haven't been able to nail interest rates down to a science, if you will, I wanted to take some time and post some forecasts by some other well-known economists out there. The first one comes from Freddie Mac's chief economist, Sam Cater, saying that with the rate of inflation decelerating, rates should gently decline over the course of 2023. At the same time, you have the National Association of Realtors forecasting that rates will drop to 6% by the end of 2023 and to 5.6% by 2024. At the same time, you have the head of Bank of America Retail Lending saying that he expects rates to fall to 5.25% by the end of the year. In addition to the Mortgage Bankers Association chief economist expecting rates to hit 5.6% by the end of 2023. And lastly, you have the Realtor.com economists saying that they expect a gradual decline that could bring rates down to 6% by the end of the year, and that rates will average 6.6% over the third quarter. So whether or not rates come down a lot from here, I think it's more important to note that you're not likely to see any huge jump in rates, which more or less means that you have status quo for the housing market. So lastly, what are we expecting with home prices through the end of 2023 into 2024? My personal belief is that you see more price stability, which means that you're not seeing any declines in housing prices, and that's largely due to the fact that inventory is low, demand is low, which creates that stability in the market. At the same time, I believe interest rates are going to pull back, which is going to get some of those people off the fence, which is going to increase buyer demand, in turn creating some small appreciation in home prices. The latest report from CoreLogic shows that they're expecting a 4.5% increase year over year from May of 2023 to May of 2024. And it's largely due to the reasons that we talked about in this video. Now, earlier in the video, I mentioned that real estate is local. Here's a nationwide map that shows which markets are still appreciating the most and which markets have still seen a year-over-year decline in home prices. And at the moment, it's largely on the West Coast where we saw the most appreciation. And the states that are still doing relatively well are those markets where it's a little bit more affordable to live. At the same time, many of those markets are red states, which is where many of the people on the West Coast were migrating to during and after the pandemic, which has not only kept those housing market stable, but also cause them to appreciate more than anywhere else in the country. So if you're someone out there looking to buy a home, I'm going to tell you what to focus on in just a minute. But first, I want to talk to the people who are expecting a crash, who are expecting home prices to crumble. The reality is it's not going to happen, and it's largely due to this chart right here, which shows that 39% of Americans own their home free and clear, which means there's no mortgage on it at all. Another 29% of homeowners owe less than 50% of what their home is worth, with the remaining 32% having less than 50% equity. And of that 32%, a large percentage of those people actually have equity in their property, which means distressed sales aren't likely to happen. And that's ultimately what crashes housing markets. So without supply, without distressed sales, you're not going to see any big changes in the market. But if you are looking to buy a house, I think it's important at the moment to focus on the long term. And what I mean by that is somewhere around 5, 7, even 10 years. And that's because there is a really good chance that home prices don't appreciate the 4.6% average that we've seen over the last 65 years. You're more likely to see appreciation in that 2 to 3% range. And because selling costs on homes are somewhere between 6 and 7% depending on your market, you could be underwater if home prices stay flat and you need to sell that home within the next couple of years. But if you focus on having that longer term time horizon, focus on making the payments, not only are you paying down the principal on that loan, you're likely also getting some appreciation. Whereas if you're renting, you're just paying your landlord's mortgage. At the same time, you want to make sure you have money in the bank, you want to make sure you're comfortable with the payments, and that you're not stretching yourself. Yes, I'm a real estate agent. Yes, I make money selling homes, but this video isn't about that. This video is about educating you so that you can make the best decisions for yourself.